minutes left in the trading day, and we are now in the closing bell market zone. Commercial-free coverage of all the action going into the close. And today we've got Veritas Financial Group managing partner Greg Branch and Fairlead Strategies founder Katie Stockton. Very good afternoon to you both. Let's kick things off with the broader markets. Stocks are sinking today, as we've been discussing, but off the worst levels of the day. We're currently down 360 points or 1% on the Dow. The low of the session was down 505. First question, Katie, to you, and these levels and the pullback that we're seeing. Anything particularly stand out to you in terms of trying to decide if this is just a one-day move or not?
Yeah, I think it's probably more than a one-day move, but we're not seeing a lot of breakdowns with this pullback, which I think we should really just look at as a retracement of where we've come from. When I looked at the S&P going back to that late July low, it was up nearly 6%. So some kind of retracement is very natural once you've had overbought conditions in place for some time. So I just simply think we're seeing a reaction to those overbought conditions via a loss of short-term momentum. We do expect a test of the 50-day moving averages by both the S&P 500 and the NASDAQ 100. They're just over 2% below current levels before this pullback matures.
The data in the last, 24, 48 hours, Greg, has been a little bit weaker. Retail sales today, home builder sentiment, which we'll talk about, the consumer sentiment number last week. Anything giving you cause for concern amid the booming economy otherwise?
Well, with the consumer, we have to wait a bit, right? So the drop to 1.1% was somewhat to be expected as we rolled off of Amazon Prime Day and as physical stimulus put up diminishing returns. The University of Michigan study was a bit more alarming, going to a low we haven't seen at 70.2 since 2011. But that's a sentiment-driven measure, and sentiment sometimes gives us head fakes. And so it bears some watching. Certainly the Delta hasn't proven to be deleterious to the labor market. We saw two pandemic-level lows the last couple of weeks, and 385,000 jobless claims and then 365,000 jobless claims. So it certainly hasn't proven to be a headwind for the labor market, which I think the Fed will have to take notice of. We still have 10 million openings last month and only 9.2 million people who are either underemployed or looking for employment. So it's become very difficult for them to present the argument that we need to keep easy monetary policy in order to for the health of the labor market. That's a very difficult argument to make now.
S&P down a little more than 0.8%. Shares of Home Depot tumbling despite posting an earnings beat. Little miss on sales. Let's just get to Courtney Reagan for more on retail, Courtney, which is not looking pretty today.
Yeah, Sarah, in general, the U.S. consumer has actually been on fire, but expectations then for these two recent winners, Walmart and Home Depot, were really high going into the earnings prints. So even good results weren't quite good enough to move those stocks higher. So Walmart and Home Depot actually both beating analyst estimates for earnings and revenue. Walmart raising its full year forecast, but Home Depot declining to give one, citing just continued uncertainty. Another divergent point between the two Dow components. Walmart's comparable sales beat expectations for the U.S., but Home Depot's disappointed, even though the metric grew on top of the 25% growth in the same quarter last year for Home Depot. Interestingly, for Walmart, its digital business contributed just 4% to the comparable sales growth this quarter, compared to a 60% contribution last quarter. Now, July retail sales did fall a little more than 1% from June, month over month, according to the Commerce Department, but did grow nearly 16% year over year. So it does look like some deceleration in the broad look from the government, but year over year, pretty strong. And again, consumer strong, expectations high. You got to really hit it out of the park to be a winner for investors.
Courtney Reagan. Courtney, thank you. Katie, what do you look at when you gauge the health of the consumer, at least what the market is telling you? Because consumer discretionary has Tesla and Amazon, some big weights. XRT is pretty much, it's down today, but it's holding its highs. That's the ETF. What should we be following?
You know what I'm watching is the ratio of XRT, or the retail ETF, to this consumer staples ETF, or XLP. And you'll see in that ratio that it has broken a short-term support level. So it suggests that as these consumer discretionary and retailers, they hit the tape with their earnings reports, that perhaps they have a little bit more to prove. You're, of course, seeing that with the gap down in Home Depot, the weakness in Target. These reactions are negative, but it's really just a short-term pullback within the scope of their longer-term uptrend. So I'd make sure to contextualize where they've come from, and also for the fact that really the long-term moving averages are still very much pointing higher, and this just feels like a relief of that overbought reading coming into the earnings reports.
Greg, what's your take on those consumer names, either those two specifically or more broadly the data we've had, retail sales, consumer confidence, and whether it's a significant concern?
Right. I agree with Kathy. In the short term, we are going to see the consumer deteriorate. We're going to have 7.5 million people coming off of generous Fed employment benefits on the other side of September. But that deterioration will not be spread equally. At the top end, I think you'll see some protection. And I think that it will continue to drive share gains for the value retailers. At the end of the day, as the inflationary pressures continue, and as I said, when we see people come off those generous benefits, the purchasing power of the average American family's wallet will be vastly decreased. And so I do believe that the value retailers will continue to gain share, and I'd particularly look at those who have taken the year to invest in their e-retail capabilities, whether it's shortening delivery durations, off-site fulfillment, channeling some of that data they're collecting into the on-site experience. I think you've seen in Walmart's results and Target's before that this is starting to bear out, that they've put in place some pretty strong structural advantages. And so Target had 20% top line, which blew out consensus, and 9.8% operating margins. Walmart, as we said, basically killed on every metric. They doubled consensus comp expectations at 5.6%. We even saw 80 bips of operating leverage. And so, for the second quarter in a row, they had to upgrade their guidance. And so I think that they will continue to gain share as a sector and continue to gain share of those names in particular.
Home builder stocks under a lot of pressure after we saw the weakest sentiment survey in about a year. Diana Olick has those details for us. Diana.
Yeah, Wilfred, the street was expecting a small drop, but not 5 points on the NAHB's monthly index. And that sent the home construction ETF, that's ITB, down around 3%, along with big names like Lennar, Pulte, and D.R. Horton, also off on the day, although still way up year to date. Now, the builders pointed to continuing rising costs for materials as the problem. The price of lumber has come down dramatically, down over 72% from its peak in May. But price and availability of other building materials like drywall, flooring, appliances, and windows still way up, and that is trickling down to buyers in the form of sticker shock on today's new homes, which is, of course, hurting demand for those homes. Back to you guys.
Diana, thanks so much for that. Katie, I wonder what you've been making of either these stocks or commodities like lumber, and what the charts are telling you there.
It's a corrective phase within a long-term uptrend. The home builders actually had a nice relief rally off of their oversold reading, and now that relief rally is losing steam. It's not really specific to those home builders, so it's sort of a broad-based top-down move. Most stocks are being influenced just over the past couple of days by the loss of short-term momentum, broadly speaking, and that's very normal during a pullback. Pullbacks tend to leave no stocks unturned, I guess you want to say it that way. But the home builders look bullish to me beyond the very near term, so I'd be considering adding into the weakness that's associated with this top-down move.
Let's hit the travel stocks, also taking a big hit today. Cruise stocks like Royal Caribbean, Carnival, Norwegian, all down 3% or more. And airlines are all falling 2 to 3% as well. Casino stocks like Las Vegas Sands and Wynn Resorts taking a leg lower, with other travel names today now down double digits so far for the year as reopening uncertainty weighs. But Greg, you still think there's some true earnings power in these casino names specifically?
Absolutely. And I'm going to do a rare thing here and admit that I was wrong on my outlook on this probably a year ago. My thesis for these names a year ago was that those that were leveraged to Asia would see a quicker recovery as the Asian markets were much more progressed on the containment of the COVID. That thesis was pretty backwards. Where I expected weakness in Vegas, Vegas has been particularly strong. We saw June EBITDA at Wynn double what it was in April. We saw quarterly revenue up 100% sequentially from the previous quarter. And so I was wrong. The strength is actually coming from the U.S. market and from Vegas. I was concerned about those group bookings. They've put up record group bookings for the second half of 2021 and are meaningfully above the 2019 level for 22-23. And so, yeah, the normalized earnings power on these names is $3 a share in earnings and $3 in dividend. They're trading at 10 times EV to EBITDA, 10 and 11 times when you look at Wynn and Las Vegas Sands. And so I do believe Asia will be a source of strength eventually. I've been surprised at how strong the domestic market has been. I only expected that to appear in the regional casinos that they owned. And so, yeah, I think that this is a great opportunity, albeit we may get some more deterioration while Asia gets its vaccination rates up.
Famed Big Short investor Michael Burry revealed he's betting against Cathie Wood's ARK Innovation ETF. ARK is down more than 1% today. And Katie, you've been looking at the technical support levels for the main ARK ETF of late.
Yeah, certainly you just broke up there, but I would never bet against Cathie Wood. But the ARK K fund is certainly testing a key support level in my work. It's just shy of $115. And if it is broken more decisively, meaning we see a couple of daily closes below that support level, which is derived from something called the cloud model, that would increase risk in the near term with the next real major support back at the May lows. If you recall, the May lows for RK were closer to $100. And to me, that, of course, would suggest that the high growth outperformance that we got accustomed to off of the May low, perhaps for now, is coming to an end. When these do rally, they're very high beta, so we always try to capture them on the upside and also the downside. But right now, there really is downside momentum behind that space. And we don't have signs of downside exhaustion yet. Back to the casinos, that's where we're seeing signs of downside exhaustion in my work. The oversold buy signals have developed in those travel and leisure names. But of course, they still haven't yet seen that momentum uptick that gives us confidence in adding exposure. A very simple way to look for that is to watch something like a 20-day moving average, a very short-term moving average. And when those start to turn up, then you can feel more comfortable adding exposure to these kind of high growth and high beta type stocks.
She's taking the other side, Greg, of your casino trade. We've got about a minute and a half left to go before the close. Just want to run you through the major averages and what kind of action we're seeing here into the close. Dow is down a little more than 300. No, we're rallying a little bit here. Down 288 points. I say that because we were down more than 300 for most of the final hour of trade. Down a little more than 500 at the lows of the day. We are still seeing big declines in names like Home Depot weighing on the Dow, taking 91 points off. Boeing, a big laggard, Caterpillar, Disney, Goldman Sachs. But there are some winners out there, including healthcare names. United Health, J&J, those are the leaders in the Dow. Look at the S&P 500. It is lower on the day, and you are seeing broad-based weakness. But just in the final minute or so, you've got some dip buyers coming in because it's not just healthcare in the green. Now it's consumer staples, real estate, and utilities. So defensive sectors that tend to move up when yields are lower and when there's a little bit of nervousness out there. But there is some buying activity going on. Consumer discretionary is the worst performing sector. Materials, industrials as well. The NASDAQ hit the hardest today, down about 1%. You've seen declines in big names like Amazon. Tesla's down 3%. Facebook, Nvidia has been a weak performer this week ahead of its earnings on Wednesday, which is going to be key. Nvidia down 2.5%. And the Russell 2000 down the most, 1.2%. It is down almost 8% from the recent highs. The Dow looks like it's going to close lower by about 0.8%. S&P down 0.7. Keep in mind the perspective, though. We're breaking a 5-day winning streak and coming off of record highs.
And four sectors, in fact, just into the green at the close. There had been only one, healthcare, for most of the session. Welcome to the Closing Bell, everyone. I'm Wilfred Frost, along with Sarah Eisen. As Sarah just mentioned, the Dow closing down 280 points, well off the session lows of down 505. That was enough for a 0.8% decline. S&P was down 0.7. NASDAQ down 0.94. Sectors higher. Healthcare led them up 1%. Consumer discretionary, the worst performing sector, down 2.3%. Coming up, we'll have much more on today's sell-off and whether it could be the start of a larger pullback when we're joined by Wharton Professor of Finance, Jeremy Siegel. Greg Branch from Veritas Financial Group and Katie Stockton from Fairlead Strategies are still with us. And Phil Camparelli from JP Morgan Asset Management joins the conversation as well. Before we dive into the analysis, let's first of all get a breakdown of all of today's action from Bob Pisani at the New York Stock Exchange and Josh Lipton from the NASDAQ. Bob, let's start with you.
And the question, of course, all day is how much is the Delta variant actually changing consumer behavior? The theory has been just a little bit. But as we saw today, the concerns accelerated, which we saw retail sales a little bit weak. We saw consumer sentiment a little bit weak last week. And the China growth numbers were not particularly strong either. So if they're having some impact, the question is how far does it go? Take a look at some of the travel and leisure stocks. Caesars, the casinos have been weak for a while now, but the last couple of days, rather noticeably, Caesars was, $90-some a couple of days ago. Now you see $83, a decline there. But a lot of these stocks topped out in May or June. So this is not some kind of thing that's happened immediately. Same thing with the consumer discretionary group, Gap, for example. Lowest level since March for Gap right now. But again, it too topped out back in May. As you can see there, decline of about 4%. A lot of the clothing stores were down. Some of the home builders were weak as well. Restaurants were weak as well. Same situation with the industrials. Again, very similar chart patterns here. The top of the recovery market, the reopening market was in May for most of these big industrials, materials, and consumer discretionary stocks. That's the same with Caterpillar today. Most of the big materials, industrials, Freeport, Nucor, Caterpillar, all down about 1.5% to 2%. The big winners on the day, generally, Sarah got it right, healthcare. In fact, healthcare has been an uptrend for a while now. Vertex, Pfizer, Gilead, Biogen, all of these stocks have been very, very strong for the entire month of August. So what's it all mean? Not a dramatic move. Just take a quick look at the VIX here. 15 to 16. It was 17 to 18 throughout most of the day and was as high as 19. This is very typical of these midday suddenly flurries of activity, and then it just fades away. This is why people buy the dips, because you don't see any real permanence with panic staying up very high. S&P 500, 1% off the highs. So, guys, the question, Sarah, the question is concerns about the variant worth 1% decline? Most people say yes, and many would say a lot more than that. Sarah?
Yeah, well, we're starting to see it in the U.S. data a little bit. Lockdown in New Zealand over one case. Bob, thank you. Okay. NASDAQ big underperformer today. Josh Lipton with a look at what's driving the exchange lower. Some heavy pressure on the tech names. Josh, not Bob.
So, Sarah, big tech names trending lower here. Amazon, let's start there. That was falling in today's trade, down about 15% from its 52-week high. Now negative for 2021, by the way. Alphabet also in the red. Keep in mind, of course, the run on this one. It's up about 55% so far in 2021. Facebook feeling pressure as well. Worst day there since July 29th, though. Like Alphabet, of course, enjoyed a nice run, too, up some 30% so far this year. Also, check out PayPal, though, down now about 8% in just the past month. And have a look at the chips, the SMH, the ETF that tracks the chips. Worst day in a month. And under the hood of that ETF, names like NVIDIA, Qualcomm, Taiwan Semi, all lower. NVIDIA reporting earnings results tomorrow after the close. Back to you all.
Josh Lipton. Josh, thank you very much. Let's get back to our panel now. Talk more about what we saw today. Greg, was it encouraging that you saw some dip buying into the close there with some of the sectors turning green? I mean, clearly there has been this mantra and this feeling on Wall Street that Fed's still going to be easy policy, even if we do start to see the taper. We've still got a ton of fiscal stimulus out there, and the economy is still doing relatively well, even with some of the headwinds we're dealing with.
Right. I don't know if I was encouraged or discouraged. I think we'll be volatile for at least the next couple of weeks. You know, we've just gone through an earnings season where 85% of companies that reported beat their earnings, and that has or beat their consensus, and that's been my thesis for a while, that consensus was underappreciating and underestimating what the earnings power of the companies were. You know, when I looked a couple of months ago, consensus in most sectors was 60 or 70% of pre-pandemic levels, and so, you know, it's an earnings season that we expected, and now the market's asking what's next. And so we're starting to hear rumblings again of the Fed tapering, or at least announcing tapering potentially this year. The market's going to look for some clarity about that at Jackson Hole. And as I indicated earlier, it's become almost indefensible that the Fed at this point can make an argument that easy monetary policy is still necessary to bring the labor market back to health. You know, we had pandemic low jobless claims numbers 2 weeks in a row here, absent a couple of data points in June and July. And we have 10 million plus, a record 10 million plus job openings, and only 9.2 million people who are underemployed or looking for employment. So I think we're going to see this for a while. I think we're going to see some back and forth until the market feels a strong direction from the Fed, as we are now doubting that they can continue this current posture.
Phil, we were discussing earlier the state of the consumer in light of consumer confidence, retail sales data. Do you still think the U.S. consumer is very strong?
Yeah, Wilfred, good to be with you here today. So the short answer is yes. In fact, we believe that the consumer is in the best shape that they've ever been in. If you look at where interest rates are, so borrowing costs, if you look at what has gone on in the stock market, so the wealth effect that people have shared, and also where you look at the jobs market. You know, the jobs market is really, really healthy right now. And Wilfred, the reason why that's important, if you get the U.S. consumer right, you can get growth right, you can get earnings right, because the U.S. consumer represents 70% of the U.S. economy. You add on top of that, Wilfred, just how accommodative financial conditions are. Again, financial conditions are the most accommodative they've ever been. And with what we know now about what we're seeing in the Delta variant cases, we would agree with Jerome Powell and what he said about it, that this U.S. economy is resilient to each additional wave. So all of that points to our overweight in stocks versus bonds in our multi-asset portfolios.
You're not worried about financial conditions, though, changing, Phil, if the Fed does begin to taper in the coming months?
Yeah, so Sarah, I love this question, and I'm going to hark back to 2013. Tapering isn't tightening. So unless we're wrong about inflation not being transitory and inflation having a 5 handle next year as well as this year, then, and if the Fed has to move up their tightening regime, so again, not tapering, but tightening, financial conditions are going to stay very, very accommodative, Sarah. So we're trying to delineate between tapering, which is priced in, and we all hope that they're tapering by the end of this year, because that probably means COVID is in the rearview mirror. So we're rooting for that. And we're distinguishing that from tightening monetary policy through the federal funds rate, which we still believe is a 2023 event, Sarah. So still a pretty nice runway for financial conditions.
Katie, quite a big jump in the VIX today. What do you make of volatility levels?
You know, it reflects market sentiment, of course, from a technical perspective. So you do tend to see little short VIX spikes while the market pulls back, and that's very natural and normal behavior. The VIX did clear its 50-day and also 20-day moving average pretty decisively, and that suggests we'll probably see a little bit more of a volatility spike out of the VIX before the pullback matures in the coming, say, week or two for the S&P 500. We're making the assumption that this pullback will look a lot like other pullbacks have year to date. There are no big, scary sell signals on the weekly charts or on the monthly charts. It really, at this point, is still very much a short-term issue, and you do tend to see little kind of knee jerks out of that VIX during those periods. Sentiment, however, from sort of a bigger picture perspective, you would think that with the major indices up near all-time highs that people would be more greedy or exuberant. But indeed, they're not. They're really much more fearful right now, and there's any number of things to be fearful about, of course. So with that, you tend to see more cash being put to work when you get these pullbacks, and that helps really contribute to the resiliency of the tape.
Dollar strengthened today on that fear factor trade. Phil, final question to you, since you're the bullish one. How much of your view is predicated on fiscal stimulus? And I ask because we did see signs in today's retail sales number that the waning effect of fiscal stimulus will hurt consumer purchasing for big, heavy, durable goods and that sort of thing. It's been strong. And there are also questions now, whether right or wrong, about what might happen to President Biden's approval rating, the geopolitical fallout, and what that might mean for his agenda while he's trying to get, another $4.5 trillion crossed over the line in fiscal spending.
Yeah, Sarah, that's a great question. And we are making a bet, like the Fed is making the bet, that we're going to get a ton of labor supply to come back into the market, and that will fill the gap of the fiscal stimulus and the benefits that are waning. So even though the $625 per week is going back down to $300 per week on the weekly unemployment benefits. We're expecting, and the last labor report was a really good validation of this, we created almost 1 million jobs, but that will backfill the fiscal side. As far as the agenda goes, it's still too early to tell on that. I think the infrastructure plan can still happen. But Sarah, we don't want to base our fundamental growth story, our 8.5% growth story for the third quarter, our 5% growth story for the fourth quarter on fiscal stimulus. We want to base it on a post-COVID regime where people are getting back to work, where you don't need the fiscal stimulus anymore.
Well, we've had trillions of it, though, so that's surely helping us get to those kind of growth numbers.
Sure.
And by the way, Bank of America took down to 4.5% for third quarter as of today. We'll leave the conversation there. Greg Branch, Katie Stockton, Phil Camporelli, thank you all for joining us on a big market day. Still ahead on the show, Wharton finance professor Jeremy Siegel on whether slowing global economic growth concerns will continue to weigh on this market after today's sell-off. Plus, Tilray shares are popping after announcing a deal with cannabis dispensary company MedMen just moments ago. Tilray CEO Irwin Simon will be here to discuss that news straight ahead. We're back on Closing Bell in just 2 minutes.